Okay, so we're tackling Sterlite Technologies Ltd today, or SPL, for those
Yeah.
in the know.
Right, STL.
And
A lot of material here.
yeah, you've really gone all out. You've sent over earnings calls,
Mhm.
press releases, financials, like the whole shebang. I'm pretty sure you're trying to get a handle on whether they can actually hit their goal of being a top three player globally in optical connectivity.
Yeah, I mean, that's the big question, right?
Yeah, especially with all this buzz around data centers and AI, like those seem to be STL's big bets right now.
Definitely.
But the thing that kind of jumps out at me is that global demand for optical fiber cable actually dipped in 2024.
Yeah, it's a bit of a head scratcher.
So it's like their core product, the market's kind of soft, but they're still aiming for the stars. And
Yeah.
on top of that, they've got this huge order book, like over our sun. 9,000 core, something that's not quite adding up for me yet.
Well, let's maybe we should start with that earnings call transcript.
Okay, yeah, good idea.
It really digs into why that OFC demand is down, and they specifically call out China. Apparently, they have the lowest OFC volumes in 4 years. So that's definitely going to impact global numbers.
So is it more like a China problem than like an overall trend?
That's what it looks like outside of China. Demand actually grew by almost 3%.
Interesting.
But here's where things get a little more interesting. The transcript also points to a potential bright spot: data centers.
But centers, okay, yes, so everyone's streaming and storing everything in the cloud. More data equals more data centers, right?
Right. But it goes beyond just streaming. We're talking a projected 22% annual growth in global data center capacity between 2023 and 2030.
Oh, 22%. Okay, that's a serious number.
And this is where STL is placing their bets. They're banking on data centers as a major growth driver for their optical networking business.
Okay, I'm starting to see the connection here.
They're not just providing the cables, though. Data centers need a whole ecosystem of optical connectivity products to actually function.
Makes sense.
We're talking connectors, panels, transceivers, all the things that make sure that data is flying around smoothly and efficiently.
So it's like plumbing, you need the pipes, but you also need all the fittings and valves and stuff to make it all work.
Exactly. And STL wants to be that one-stop shop for everything.
Ambitious. But their earnings call transcript only showed 22% of their optical networking business revenue coming from data centers and enterprise products,
Hmm.
which seems a little low if they're aiming to be top dog globally.
Hmm.
You know, what do you think? Are they missing the boat here?
It's a good question. They're definitely talking up their data center focus, but maybe they need to step up their game to really dominate that market.
Right.
And this is where the whole AI thing comes into play.
AI,
Yeah.
the word on everyone's lips.
Yeah.
What does AI have to do with fiber optics and STL?
Well, think about it. AI needs a ton of processing power, which translates to tons of GPUs crammed into these data centers, and all those GPUs need to communicate, generating a massive amount of data traffic.
So more data, more need for, you guessed it, fiber optic cables.
You got it, but it's not just about quantity. AI data centers need a different breed of fiber optic infrastructure, one that can handle much higher bandwidth and lower latency.
Okay, so what are we talking here? Like how much more fiber are we talking?
Think 5 to 10 times more fiber than your average data center.
Wow, 5 to 10 times, that's a huge difference. So is STL essentially betting that AI is the future of data centers and they want to be the ones supplying the infrastructure for it?
That's a good way to put it, and it seems like they're putting their money where their mouth is. They've developed a specific portfolio of products just for AI data centers. They call it their AI data center portfolio.
Okay, I'm intrigued. Tell me more about this portfolio. What's so special about it? Is it just more cables or is there some secret sauce here?
It goes beyond just cables. We're talking high-density fiber with something called IBR technology, advanced panels, copper connectivity systems, the works.
IBR technology, all right? That sounds pretty fancy. Break it down for me. What is IBR and why is it so important for these AI data centers?
IBR stands for Indexed Bend-Insensitive Ribbon. It's a type of fiber optic cable that's designed to be bent or twisted without losing signal quality, which is super important in data centers where space is at a premium and cables have to be routed through all sorts of tight spaces.
So like those bendy straws that don't kink up, but for data?
Yeah.
I'm starting to get how STL is tailoring their products for this whole AI-driven demand. But can they really hold their own against the big guys in the data center market?
That's the million-dollar question they have, the tech and the strategy, but can they actually pull it off? I think we need to dig into their financials and the competitive landscape to get a better picture.
Well, luckily you sent us enough info to do just that. Before we do, though, let's touch on their global services business. They just snagged a monster contract, 2,600 crore for the Bratnet Phase 3 project in Jammu and Kashmir.
Yeah, that's a big win, especially with all the focus on digital infrastructure in India.
It really shows their commitment to that market.
Right.
But, government projects can be a bit of a wild card.
Yeah, for sure.
What are some of the risks they're taking on with this deal?
Well, government projects are always susceptible to delays and budget changes, which could impact STL's bottom line.
Right.
And this particular project involves laying fiber in a pretty challenging region geographically, so that adds another layer of complexity.
So high risk, high reward.
Mm.
They're betting big on India's digital future, but there are definitely some bumps in the road. Okay, let's shift gears for a moment and talk about their STL digital unit. They hit a major milestone, EBITDA break even.
Yeah, that's a big deal, especially for a relatively new part of their business. It suggests they're on the path to profitability in the digital services space.
EBITDA always sounds a bit like alphabet soup to me. Can you remind us what that means and why it's such a big win for STL Digital?
Sure, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's a measure of how profitable their operations are. Reaching EBITDA break-even means that STL Digital is bringing in enough revenue to cover its operating expenses.
So they're not bleeding cash anymore.
Exactly, which is a good sign.
Okay, that makes more sense. So they're not making a profit yet, but they're at least not losing money on their core operations.
Yeah.
But what exactly is STL Digital doing? Like, what's their bread and butter?
They're taking STL's expertise in connectivity and using it to provide digital transformation solutions for enterprises.
Okay.
Think cloud computing, cybersecurity, data analytics, basically helping businesses go digital.
So not just laying cables, but helping companies actually use those cables to transform their businesses.
Exactly. And they're having some pretty impressive wins. Remember that Vedanta project they talked about in the earnings call?
Vaguely.
They migrated 8 of their business units to a single unified cloud platform that's a massive project with something like 15,000 users.
Okay, that's serious stuff. It sounds like they're showing they can handle these big, complex digital transformation projects. So we're starting to see a picture emerge here. STL is going all in on data centers, AI in India, all while trying to become a top player in optical connectivity and digital services.
Right.
Are they biting off more than they can chew? Or are they strategically setting themselves up for future success?
That's the question, isn't it? To get that answer, I think we need to dive deeper into their financials and see if their numbers can back up their ambitions.
Sounds like a plan. Let's crunch those numbers and see what story they tell.
Okay, so let's get into those financials and see if STL can back up all this big talk.
Sounds good to me. They mentioned a slight dip in revenue for Q3 of FY25 coming in at ours, 1,261 crore. I'm guessing that's partly due to those lower OFC volumes we were talking about.
Yeah, that's definitely part of it. The slowdown in China and the lower revenue from their global services business. Those are the main culprits.
Right, and they're planning to spin off that global services business, right? That whole demerger thing.
Exactly.
Let's unpack that a bit more before we move on. Where do things stand with that?
Well, it's already been approved by STL's shareholders and creditors. The demerger petition was filed with the National Company Law Tribunal, or NCLT, back in October 2024, and the final hearing is set for January 30th, 2025.
So just a few days from now. What happens if the NCLT gives them the green light?
If it's approved, the global services business will become a separate entity called STL Networks Limited, and they're planning to list it on the stock exchanges pretty soon after that.
So 2 publicly traded companies instead of 1. It's like they're splitting into twins. How does that impact their financials, especially with that dip in revenue we talked about?
It definitely makes things a little more complex. We'll have to look at the performance of each business separately, but focusing on Q3, that dip, isn't necessarily a red flag considering the overall market conditions. What's more important is their profitability, and their EBITDA margin actually improved year over year and even quarter over quarter, hitting 10.5%.
Okay, hold on. Remind me again what EBITDA means. It's one of those acronyms that always tricks me up.
No worries. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically a way to gauge how efficiently they're generating profit from their core operations.
Oh, okay.
And that 10.5% margin suggests they're doing a pretty good job despite the revenue challenges.
So they're squeezing more profit out of each rupee they earn, even with the lower revenue.
Exactly. It shows they're managing costs well and focusing on profitable growth, which is a good sign, especially with all these big projects they have in the works. But remember, EBITDA doesn't tell the whole story. Did they actually turn a profit for the quarter?
That's a good point. What does the bottom line look like?
Not quite in the black just yet. They reported a profit after tax loss of our 23 crore for Q3.
Okay.
But here's the silver lining. Those losses are shrinking year over year, so they're moving in the right direction.
So, making progress. What about their debt? Didn't they mention something about a net debt of over Rs 2,000 crore in the earnings call? That seems like a lot.
It's a significant number for sure, but debt isn't always a bad thing. Companies use debt to finance growth and expansion. The key is making sure it's manageable and doesn't become a burden.
So how do we know if their debt is manageable or not? What should we be looking at?
One important metric is the debt-to-equity ratio. It basically tells us how much debt they're using compared to their equity. As of 9 months into FY25, their debt-to-equity ratio was 0.75.
Okay, break that down for me. Is 0.75 good or bad? What does that tell us about their debt situation?
Generally, a ratio below 1 is considered healthy. It means they're using a reasonable mix of debt and equity to finance their operations. However, there's a bit of a catch.
I knew there had to be a catch. What is it?
Remember that global services spinoff we talked about? Well, that could change their debt-to-equity ratio quite a bit. We'll have to see how the debt gets divided between the two companies.
So it's like renovating a house. You can take on some debt to do the upgrades, but you don't want to end up with a mortgage you can't afford.
And it's all about finding the right balance. And with this spinoff, we'll definitely need to keep a close eye on their debt situation to see if it creates any additional risk.
So potential risks from the demerger and the VartNet project. Anything else we should be worried about?
Well, there's that elephant in the room. We should probably address that $96.5 million jury verdict against STL's U.S. subsidiary.
Oh, right. That whole legal battle with Prysmian Cables.
Yeah.
What's the latest on that, and how much of a financial hit could it be for them?
It stems from a lawsuit alleging that STL's subsidiary violated non-compete and confidentiality agreements. The financial implications are still a bit up in the air, though, as they are appealing the verdict.
So a lot of uncertainty.
Uh-huh.
What are the possible outcomes here? Best case, worst case?
Best case scenario, they win the appeal and the verdict gets overturned. Worst case, they lose the appeal and they're on the hook for the full $96.5 million, which would definitely have a significant impact on their financials.
So if a major wild card in their future, we'll need to follow this one closely and see how it unfolds.
Absolutely. But on a more positive note, their focus on data centers and AI seems to be paying off. They've secured some big orders for their data center products, and that contributed 22% to their O&B revenue in Q3.
Yeah, we touched on that earlier. They're definitely making some progress there. They also mentioned in the earnings call that they're working with Indian telcos on something called Fixed Wireless Access, or FWA. What's that all about?
FWA is a way to deliver broadband internet wirelessly, which is particularly relevant in India, where it can be difficult to lay fiber optic cables everywhere. Think of it like a shortcut to providing broadband connectivity.
So instead of digging trenches and laying cables, they're beaming internet signals through the air.
Essentially, yes. And it allows them to reach areas where traditional fiber deployment is either too difficult or too expensive.
It sounds like they're trying to be involved in every aspect of the digital infrastructure build-out. From data centers to FWA, they want to be the go-to provider. Is that a smart strategy, or are they spreading themselves too thin?
It's a bit of a double-edged sword. On one hand, diversifying their offerings allows them to tap into multiple growth markets, but on the other hand, it requires significant resources and expertise in a lot of different areas. It'll be interesting to see how they balance this expansion with their core business.
Well, they seem to be managing their digital business pretty well, hitting that EBITDA break-even milestone. What's next for them in that space? Are they going to just focus on India, or are they looking to expand globally?
Their ambition seems to go beyond India. They mentioned a strong deal flow and new customer wins in the earnings call, which indicates they're actively pursuing opportunities on a global scale. And remember, that Vedanta project, that was a global project, so they clearly have the capability to operate internationally.
Okay, so thinking big,
Yeah.
which is in line with their top 3 goal, but can they actually pull it off? What are some of the biggest hurdles they'll face?
Well, competition is fierce in the global market. They're up against some heavy hitters in the optical connectivity and digital services space.
True. It's not going to be easy to take on those giants. But what about their strengths? What are they doing well that could give them a competitive edge?
Their focus on innovation is definitely a strength. They're constantly investing in R&D, developing new products like those AI-optimized solutions we talked about, and exploring new technologies like FWA.
Innovation is key, especially in such a fast-paced industry. They also seem to be pretty strategic in their approach, targeting high-growth markets like India and jumping on trends like AI and edge computing.
Exactly. They're aligning themselves with the future of the industry, which could give them a real advantage down the road.
So they've got the ambition, the innovation, and the strategic vision. But what about their execution? Can they actually deliver on all these promises?
That's the million-dollar question. And to answer it, I think we need to look beyond the financials and really dig into their operational capabilities, their management team, and their track record of execution.
Hold that thought. We're going to take a quick break, and then we'll come back to explore those deeper aspects of STL and see if they have what it takes to achieve their global aspirations. Okay, we're back and ready to dig a little deeper. We've been poring over STL's financials, their big bets on data centers and AI, and even that legal issue they're facing in the U.S.
Yeah.
So now for the big question. Can they actually make this top 3 global player dream a reality?
To answer that, I think we need to go beyond just the numbers and look at some of the less quantifiable stuff, like their operations, their leadership, and their track record.
Okay, I'm listening.
It's like trying to judge a chef, you know? You can look at the menu, you can see the ingredients, but you really need to taste the food to know if they're the real deal.
I like that analogy. So let's taste STL's execution. Where should we start?
Well, let's start with their operational capabilities. They've got a global footprint with manufacturing facilities in India, China, Italy, Brazil. They've also delivered on some pretty big projects like the Mahanet in Maharashtra and T-Fiber in Telangana.
Yeah, definitely racking up the fiber miles in India. Over 150,000 kilometers, according to the press releases. But going global is a whole different ballgame, right?
Exactly. They need to make sure that their global operations are running smoothly and efficiently, that they can handle all the different challenges that come with different markets and regulations.
Right.
It's not just about laying cable. It's about managing complex supply chains, coordinating teams all over the world, and meeting a wide range of customer needs.
Makes sense. Speaking of teams, what about their leadership? Are they the right people to steer STL towards this ambitious goal?
Their leadership team seems to have a good blend of experience and expertise with strong backgrounds in telecom and tech. Anant Jain, the CEO, he's been with STL for over a decade and has played a key role in their growth and expansion so far.
Experience is definitely a plus, but are they agile enough to keep up with this rapidly changing industry? They're moving into new areas like digital services and AI, which require a different set of skills.
Yeah, that's a valid concern. They need to cultivate a culture of innovation and agility so they can attract and keep the best talent in these new fields.
Right.
And they need to show that they can successfully integrate these new businesses into their existing operations.
Yeah, integration is key. You don't want these new ventures operating in silos.
Definitely. They need to leverage the synergies between their different businesses and create a cohesive and strong offering across the board.
Okay, so we've got operations and leadership down. What about their track record? Have they consistently delivered on their promises in the past?
Their recent financial performance, especially that EBITDA break-even in their digital business, suggests they can execute. And they've steadily grown their revenue and market share over the last few years.
True. But they've also had some setbacks, like that litigation in the U.S., which could put a damper on their future prospects.
Right. That litigation is definitely a risk factor. And their reliance on the Indian market, while it's a strength in some ways, also makes them vulnerable to the ups and downs of that particular economy.
So it's a bit of a mixed bag. They've got a lot going for them. But there are also some major challenges and uncertainties on the horizon. What are some key things you'll be watching for to see if STL is really on track to hit their goals?
Here's what I'll be keeping an eye on. First, the outcome of that global services demerger. Will it actually unlock value, or will it just create more headaches? Second, how the partner project progresses. Can they deliver on time and within budget? Third, their ability to scale their digital services business globally. Can they take that success they had with the Vedanta project and replicate it with other big clients around the world? And lastly, that U.S. litigation. How much is it going to cost them? And will it hurt their reputation or limit their access to the U.S. market?
So many moving parts. It's like watching a high-stakes game unfold. We've got the players, we know the rules, but the outcome is still up in the air. It'll be interesting to see how it all shakes out.
Definitely. And that's the exciting part of investing, isn't it? Trying to predict the future with limited information.
Well, we've done our best to gather and analyze all the information we could, but ultimately only time will tell if STL can reach that ambitious goal. They seem to have the right ingredients, but they still need to prove they can bake a delicious cake, not just a half-baked mess.
Couldn't have said it better myself.
So to wrap things up for you folks listening, STL is a company in transition. They're making bold moves, betting big on the future of digital infrastructure. They have the potential to become a global leader, but there are definitely risks and challenges along the way. Keep an eye on this one. Their journey is going to be a fascinating watch.